So, thank you for joining us today for this special session. We will explore the current dynamics of venture capital in the technology sector. We are honored to host today three eminent figures of the VC in France. So our first guest is Stéphanie Hospital, managing partner and co-founder of One Ragtime, a dynamic investment fund that has made 49 investments, correct?
I guess 47.
47?
Yes.
How many exits?
I guess 7.
Okay, good. Zenly?
Zenly, we were a very small business angel, but at least it gave us a very good carnet because we did that on the One Ragtime balance sheet. At the moment, we were not in a situation to do it. And then soon we had Chelismac, partially exited with SoftBank. Then we have made Plus Simple exited with KKR in 4 years. And then Glose with Medium. And many more. I mean, and this year is going to be a very good year in terms of exit. So we'll see, crossing the fingers. But at least we have few process.
And new investment.
And new investment, of course. But when you invest, you have to deliver back performance also for your investors. So it's super important to be exiting. And I guess that with Julien David, we have maybe one of the king of the exit at the moment. And exchange is not bad too.
1 billion. How much for the last one?
I'm not allowed to say, but the press says 1.2 billion.
Okay, sorry. So we are with Julien David Nitlec, managing partner at Iris Capital, a key player, venture capital where tech comes first. It's your baseline. And you are from seed to late stage funding. You work with companies like Exotech in the cyber, Armis in the advertising, and I advise a company from Nantes. So we are too with Alexis Dupelou. You are partner at Xange, a Franco-German fund that has made more than 200 investments. Yeah. The fund was created
20 years ago.
20 years ago. Really, you have 35 exits,
yeah, exactly.
if I'm correct. And you are in many companies. The biggest one, the last one, the biggest investment was in Animage.
A recent one. The biggest success so far was Odoo in Belgium. Open source ERP, competitor of SAP, $500 million AR, but not exited yet, fully exited.
Okay, and company like Omi and company, for example. Yeah. Today, we will discuss what has changed in the investment landscape this year. Many things have changed. And your question will be welcome, of course. You just make a sign with your hand. And my first question will be for all of us. Given to the technological advancement and economic shifts over the past year, how would you characterize the current state of tech investment in France, in Europe, and globally? Who wants to start?
Yeah,
Alexis?
I can actually. So quite difficult actually, as we were saying with Julien David. As many VC, we were penciled down for almost a year and a half. Actually, we've done only one investment, and it's a mix of super inflated environment, like some kind of tech bubble going down, and now that we are going back to work, I would say that there is a lot of background noise around Gen AI and AI in general, which is kind of a difficult bet to do when you're a VC because a lot of opportunity were completely pre-product, pre-anything basically. Which can sound a bit random sometimes. So you can always bet on very good teams, but if they don't have nothing yet, you always have a very huge risk of collapsing your investment in very few months.
True. There are many ways to try to explain that. Perhaps a simple way is there is a lot of pre-seed money. You come out of here, you say you are at 2 C-levels of whichever scale-up that you can find. You co-seed, you get about, 10, 15 funds being able to do pre-seed, and the rounds are very competitive. So the offers that are made to you can go high. You can end up with valuations 25, 30 post-money. You just have a deck of slides. Then you're going to develop the company and you're going to go into seed or Series A. You're going to be asked about your metrics. And there suddenly, guess what? Your metrics are being multiplied by the current multiples that we can see on the exit front. And if we look the other way around, I'm not as optimistic as Stephanie. Last year, there were absolutely no exit on market. We were lucky to have a few. But the truth is last year, it was a year of capital calls. All funds asked for money. And there was very few distributions. And IPOs, zero actually. We were living a historical record of non-IPOs in the US, even longer than after the bubble of 2000. So on one hand, you have a lot of money to play for the flipper, and there's no exit of the ball. So somewhere along the line of financing, there's a bottleneck that's invisible to you, but that is very visible to us, which is suddenly looking at companies, trying to project what's going to be the next round of financing, the metrics you're going to be required. So you still can scale companies, and AI will help you do that. You're going to be much more productive. You're going to spend less money. So it's not a bad sign for you as entrepreneurs, and the money to help you launch companies has never been as available as right now. Problem is, the metrics that we are currently asking companies after they launched, once they have a product so that they can show they have traction with B2C markets, with B2B market, are actually quite high. And another way to phrase that is you see a lot of pre-seed and seed. You don't see that many Series A, even less Series B if you look. So you can see that the selection competition for scale-ups is extremely harsh at the moment. And probably the fact that we have more exit, which is what we're working on, will probably free the market, but also on your side, the fact that you have to show metrics, that you have to show growth with customers, will be something that will be much more attached to than we were 2 or 3 years ago, as Alexis said, when we were right in the middle of a bubble.
Actually, if I can add anything, like so, it was all about growth before. Like as everyone knows, it's a very basic comment. But now it's about going back to economic rational unit economics, and businesses were like very aggressive in the past, but made no sense, such as like quick commerce, for instance, just disappeared basically. And then even all your well-performing company in your portfolio or in any portfolio would necessarily like reprogram themselves to moving towards rational growth, high gross margin, low cost of acquisition, a bit of layoff obviously, unfortunately, but so there was 12 months where every good CEO of any good companies anyway needed to adapt themselves to the new environment, and therefore were not going on the market basically because they would basically get stopped by VCs. So now would be probably the time where they have rework on their business plan and their organization and would be able to go again on the market and restart fundraising.
Before a question for Stéphanie, I've got a question for Julien David and Alexis. You are historical. Do you think that the situation is the same in now, this year, than in 2000 and in 2008, or is it totally different?
We're discussing that. So with Richard, we have the chance to have lived a few cycles. The young ones of you, of course not. It's very similar. In 2000, suddenly it was a land of opportunity. Web was going to change everything, and so much money was pouring into the market at valuations that were hard to understand. Mistral right now is based on press, valued possibly at 5 billion and not making any revenue yet, versus OpenAI that does billion revenue, has raised for 80 billion of valuation. So in 2000, we had this situation where web was such a transformation that it got exciting, but assimilation time by markets is very transformative. And suddenly there's a question on your business model. There's a question of what we as venture are looking for, because what used to be extremely sexy suddenly is kind of old, doesn't grow as fast, and we are creatures of fashion also. 2008, with the apparition of Instagram, the platforms, the 4G, etc., we had the same kind of transformation where suddenly you can transact on marketplaces. So yeah, it's quite similar, but the good news is these reset moments are very hard for us VCs, because doing performance is harder. You need to make it much faster before the bubble bursts, if there's a bubble. And I don't know if there's a bubble right now. It looks like the prices are high, yes. But for you entrepreneurs, it's amazing because that means we're entering an era of new innovation based on new technology and productivity that's never been seen before. And after 2000, there was 2000, 2010, BlaBlaCar, etc. Richard can tell you. And after 2008, there was basically an era of all the companies we've mentioned in our portfolio, Kiriba, Exotech, Shift Technology, Linex, and so on and so forth. So basically, that means we're on the brink of a next generation of amazing transforming companies.
Stephanie, do you want to complete? Or
Well, I'm a newcomer in this world, even if now I've been investing for 7 years with One Ragtime. So at One Ragtime, we started with a startup model when I decided to become a venture capitalist, and Richard incubated One Ragtime with French Web. I have to say that. We were hosted by Richard at the beginning. Clearly, I had no clue of how to raise money. Still, when people tell you that it's easy to raise money for fund, it's a nightmare for any investors and entrepreneurs. It's tough to raise money, but at least we were starting with no money. So it was, with no money, you have to, if you want to start a fund, you have to start with what is accessible. That is to say, the seed market, where at that time there were less people. And to be a good investor, you always see that you need to be contrarian to what the others are doing. So it means that today we prefer to invest at Series A rather than at seed stage, except if we have super experienced entrepreneurs. Because everybody is looking at seed stage, and many growth investors are investing at seed stage with no clue what it is to be a seed investor. AI, at the moment, my view is that we need to sell our AI company in our portfolio. This is the perfect moment to sell it. So it means that we've been investing in AI before. Same fintech. Nobody give a shit to fintech at the moment. We've just done 2 investments in fintech. So it's always something that as an investor, you have to be before or after the wave. Because all the investors, I'm not impressed, to be fair with you, with the level of the generic level of the VCs, because it seems to be very easy to invest in tech companies. And you don't have the same level of sophistication than private equity investors sometimes. Not my colleagues, of course. I'm surrounded by 2 superb investors, but generally speaking, in a market, it's a market where people follow. So there's a FOMO on AI at the moment, so everybody is going to invest in AI, because if you don't have the right logo in your portfolio, then your LPs are going to say, what are you doing? You're not investing in AI. And as time are long, because before success, you need to wait 5 to 7 years to know if you've been correct. It's at the end of the market that you see if you have sold your company or not. Whereas, failures come very quickly. So my view now is that for deep tech company, AI, it's not the moment to invest. You have to wait a bit, sell your company in that sectors. If you invest in those companies, AI, this is an infrastructure model. So it means that you have to be able to invest a lot of money. It's an infrastructure play, not a VC play anymore. If you can afford it, perfect. As for One Ragtime, we can't afford it, so we stay on what we can do. And then also many investors are discovering what it is to be cash efficient, profitability. I remember that as for One Ragtime, we always said that we want to have profitable but super nice company. And some companies in our portfolio, I take the example, for example, of Staycation. We invested in a company, Staycation, everybody knows Staycation or use Staycation, that was bootstrap, profitable, million revenue generation when we did the investment. And today we had the board, they multiply by 3 or 4 their volume of revenues, and the money is still on the bank. So as an investor, you would say, wow, it's not the way to go. But to be fair with you, I sleep well, and the founders are sleeping well also because they have the freedom. And when you invest in deep tech company at the moment, you need to know which company can buy it at the start. So if your founders developing a deep tech company, think hard how you're going to reach the company that tomorrow could buy you. Because if you play for a revenue play, most of the AI company today are a couple of million of euros of revenue if successful.
Okay, I stop you because you will answer to all my questions before I ask them. So I have to change now my script. But when I listen to you, there is something really interesting. You are well known for spotting company at the really early stage of the company. Sometimes before they have created the company. First question, is it simple? Is it easy to find this kind of company? And the second question is it easy to change the thesis of your own fund? Because if I have well understood, first you were on the seed stage, and now you are moving on.
We still go for seed stage, but at the beginning of One Ragtime, I would have put money in company with no revenues with first-time founders. Honestly, when it works, you say, "Wow, I'm genius." So perfect. I mean, Phantom Buster, for example, everybody knows Phantom Buster. I mean, they were first-time entrepreneurs. We were the only investors. Now it's a company that is above, I would say, 10 million. They never raise any more. I mean, just one seed. I mean, profitable since the moment we've been investing. Okay, it's not going to be a unicorn, but at the end of the day, if from a perspective of an investor, you invest at the valuation you use at start, I mean, it's easier to do a 10x than when you look for the unicorn status. I mean, we have unicorn in the portfolio, of course. Jelly Smack has been one of them. But I'm not sure I would have invested in Jelly Smack now. I mean, this is what sometimes I say, okay, at the beginning you can do crazy things, but now what I see is that repeat founders, it's easier when you have already done it. So we could invest on a PowerPoint in Frédéric Mazella or in David Gurley, a new company.
For Captain
I mean,
Cause.
Captain Cause and Hive. Hive is super interesting, peer-to-peer distributed network for storage capability and data centers, I would say, replacing the data center at some point. But then it's a seasoned entrepreneur. So the risks you take as a very seed stage investors, maybe the more you invest mature, because at the end of the day, you need to have experience to build company. So this is why investors in a whole love repeat founders. But the ones that are still hungry, that still want to make it, you have to be reasonable. I always ask the founders when I invest, I mean, because again, part of the model of One Ragtime is that we don't have so much to invest. So it means that when we leverage Club Deal to invest, I mean, you go to see investors and say, oh, believe me, it's going to be a fantastic company, this company. So if it doesn't work, you're not well. And then with the fund, we don't have yet the level of money that we can say, okay, we do a 10 million bet, and then it is. So maybe you're more selective, I don't know. But what is sure is that at the end of the day, you invest on founders and team. And it's super hard to be an entrepreneur. Everybody says that. But even, I mean, the more I invest, the more I say, okay, at the end of the day, what matters is the team. And also the level of efficiency. At the end of the day, the cash will provide the company. You can be super cash efficient when you develop an AI company, as long as you know that one day you're going to do big revenues, but it's a risky games. Whereas, I mean, when you invest in a payment model or a flow model, I mean, like marketplaces or fintech, it's a business of execution. So then what will matter is the efficiency of the money.
Yeah, so at Xange we did what many VC did during, the good years, I would say, or the booming ones. So we multiplied the size of the fund by 2.5, so 230 million. And to be fully transparent, it's not that easy, basically, because then you're like a big vehicle doing anything from pre-seed to Series B. And at some point you have some kind of, limit of size, because we won't go above like 300 million, because then you become schizophrenic, basically. So even for myself, after hunting like pre-seed company for 2 years, it's super complex to be, super Series B investor, because it's not the same set of skills. At the beginning, it's human fit with the founders. It's maybe 2-3 meetings 1 week before like issuing a term sheet if you're on a competitive topic. where, you know, it's more like when you do Series B, like investment banking style, you know, serious guy, running, you know, having suits and wearing suits, like big Excel models files. And they are the smart people, but it's very technical, and then it's a different set of skills. So, short answer is not that easy. Then you need to learn and adapt, and probably have, you know, dedicated guys within the team to specialize, because it's completely different.
Okay, let's discuss about the relationship with entrepreneur. Everything has changed. What are your concerns to them? What are the mistakes today that you see when you are meeting a new entrepreneur? Because with serial entrepreneur, of course, they know the VC game, they know how it works. But somebody who start a company and who go to meet you, what kind of mistake can they avoid?
It could be just saying that repeat entrepreneur can be a bit obnoxious, or like they need to be still flexible. You know, it's fast-moving environment, so you don't know anything about everything for the next 10 years. So it's super complex to adapt to new topic for anyone, even the most brainy guys. So I just to say that repeat entrepreneur are statistically like a very good bet, but nevertheless some of them are still a bit.
And they need to be hungry.
You have the name.
You need to have, repeat entrepreneurs that want to make it bigger and better, not just for money.
Yeah, I'm sorry, so I don't think anything changes in terms of you. We've been talking a lot about us, so I'm very careful because we're strange creatures. You meet us, you pitch us, and so what's interesting and what's been explained so far is the kind of conundrum we're in, depending on the size of the fund, depending on going pre-seed and waiting a long game where you have to reinvest a lot versus a short game. So just moving back to the question, from an entrepreneurial point of view, I'd really like to state that I think nothing has changed. And we've had the chance to accompany a lot of very good companies, Shift Technology, which I've been with for the past 10 years, which is worth more than 1 billion, reached 100 million contracted ARR. LeanIX, which actually had a very good exit, Exotech, etc. The recipe is always the same. When you start a company, because of a statement, which is we are on a market, you know, a market on which technology can be a leverage. We've talked about amount, size of funds, but our business is very simple. We meet you, you have an idea on a market that you know, where technology can change, scale, and transform things. We talked about bankers a little bit earlier on. Bankers, they work with debt, with leverage, you know, all these terms that I still don't understand. The leverage for us is the power of the technology you developed multiplied by your skills as entrepreneurs. And what are the skills? Knowing your market, being able to fit a product that responds to a need, and being able to scale out of that. Whether you scale as a smaller company, whether you scale as a huge company, will be a factor of opportunity, quality of your tech, timing of the market, plenty of factors that are both related to you and outside. So in summary, the rules of being an entrepreneur in 2024 are the same as they were when I started in tech in 1999. You need to see an opportunity, you need to know a market, you need to figure out a product that changes the deal, that accelerates, that makes you more productive. And once you have this vision, it's very difficult because you know what you want to change, but still one thing at a time, meaning you need to be able to develop that, you need to be able to hire the right people, you need to be able to scale. Which brings me back perhaps as a conclusion to the amounts that you're looking for and the funds and the conversations we had about size of funds. Right now we're living in an era where funds are being talked about as 1 billion funds, and we talked about Mistral raising 5 billion. I don't know the size of your companies right now, but it starts with 1, 2, 3 people, then turning into 5, then turning into 6. The speed of hiring, the speed of developing a tech has not changed drastically over the past 3 to 5 years, meaning that whether you raise 1, 2, or 5, you're still going to spend it the same way in the first year of the company, in the second year, which is why I remain quite reserved on the short term as to the capital needed at first to make sure that what you've chosen as a business is a good business for you to develop. Then, once you have the product market fit, then once you have a market, scaling the company to 2, 5, 10, 100 million, may require a different amount of capital depending on the speed of your market, depending on the quality of your execution. And then the mistakes, they're all the same, and that's my conclusion. Going too fast, making the wrong hires, believing that you have something you don't have already and investing in it. So conclusion, it's the same game. We're the same people. It's just right now, depending on time, suddenly there's money or there's plenty. Right now, it seems that there's plenty, and sometimes suddenly there's nothing, so it's hard to read.
It's the same people on your side, but on the side of entrepreneur, you have new kind of entrepreneur. A lot of people from biotech, from research. It's different. How do you work with this kind of entrepreneur?
I think we will have probably the same thesis with Iris. It's the fact that market has been a bit saturated because now technological barriers have decreased for everyone. You have a lot of off-the-shelf technologies, like very easily, like in bracket, but usable. And so, as we were saying, like now with a very small amount of money, you can have very decent like software with no-code tools and stuff like that. So either you would shoot for such environment benefiting of new technology, such as the Gen AI, the new wave, and we see actually exact newcomers of old companies like from 5 years ago to restart everything from scratch. So you will have a new wave of competition. Either you go on, less saturated topic, more deep tech, and this is all about like, tech intensity and having, catching the new waves of, resource constraint, like climate, like then you would need to do very hardcore hardware, for instance. So you won't make the world get better only with software, for instance. So, you need to touch new topic and then adapt to the new trends such as cyber threat and stuff like that. So I would say if you go on the digital part, then you have a new set of tools. So just be really smart about like showing stuff, like moving fast and not spending too much time on marketing and slide, but maybe wait 2 more months to have some results, metric of usage, user feedback. Or you can go very deep tech, verticalized, and then it's all about like having PhD, and France is a great country for that. So
I agree very much with what you said, Alexis, and perhaps to rebound on that, in the first case of companies you describe, the current leverage of technology is going to get even higher, meaning that it used to go for, when I started, it used to be called ASP, now it's cloud, and it used to cost 100,000, now it costs 2,000 to have, I don't know what, the right amount of Google account, marketing, whatever, to start having a visible product. With AI, for companies that are related to a market opportunity that you're going to pursue, you're going to be much more efficient. You're going to be able to automate tasks. So the truth is, the burden of your company, the number of people that are needed to be efficient will be smaller. And look at right now what's happening in the stock exchange. Google, Microsoft, Amazon, all these guys have announced tremendous results last year. And when you read the press, they say, oh, we just, we fired a few people. It's not true. They replaced them with AI. AI is already present in large groups, bringing huge productivity, and it's going to apply to you. In the second case that Alexis describes, that's where the conundrum lies. You're going to go for deeper technology, typically foundational models to help you change the design of buildings, etc. So you're going to look for data sets. You're going to have to buy GPUs. You're going to have to hire people who are quite rare. The capital intensity of these models is going to be higher. You're going to have to build hardware. Hardware is very expensive and it burns cash. So if you go for these models, the good news is money is available. And the willingness of VCs right now is quite high. 5 years ago, funding hardware, I was about one of the only guys, probably with Exchange, to do that. Right now, you come with climate-changing devices, you'll have a lot of interest. Beware. It's not because we're suddenly bullish and ready to spend much more that it means that in 5 to 10 years, the exits will be 10 times bigger. So if you take more capital, the issue will be valuation for you. You will say, well, but why should I dilute myself more than 20%? And we understand that. We're not there to take advantage of the situation. It's just, the question is not how much you should dilute yourself. It's in 5 to 10 years, how much you think a company can be worth and can be acquired for. And in between, how much more money will you have to raise, meaning how much more dilution will you have to take. So the point I'm getting at is, in the first model, you're much more efficient. So the truth is, basically cash is slightly more of a casualty. In the second model, cash is needed, but we don't know yet the value of this cash and the level of intensity of acquisition that you're going to have later on, which means that there's a huge unknown, which is bigger deep tech models, much more money. The valuations at which we'll raise them is still a question. Right now, Mistral and the likes, which are amazing examples, tell you valuation sky high. Remember, the biggest acquisition we've ever seen on the market did not happen. It was Adobe buying Figma for 20 billion. That's the biggest amount I've seen personally. Didn't work out. So the biggest amount that you can buy a company for right now, 20 billion. Mistral is supposedly, based on press, already worth 5. So either now the acquisition will be at 100 billion, and probably in 10 years they will be. But so moving back to you as entrepreneurs, sorry, I'm talking big numbers and crazy things, but it comes down to the capital you need today. And within 5 to 10 years, how we together as partners project the possible exit and the cash intensity that's going to be required to reach that exit. And it's very hard to figure right now.
On arrive à la fin. Est-ce que l'un d'entre vous veut poser une question? Je vois une main se lever, je vais m'approcher de toi.
I guess, can I ask two questions? Two questions. So actually, one for Stephanie. I think she mentioned she had a couple of exits lined up this year. I was curious about what's the landscape right now on this. I figure it probably varies depending on the segment. And the other part is, I guess, probably of any one of you. Over the last year, I figure there were like very good projects that you felt were really good. You wanted to invest in them, but you actually declined them. What was the typical criteria that made you like have this change of heart and you figured that won't work? I really like it, but I won't take it. What can be quantitative or it can be a qualitative criteria, but.
Well, maybe I will start with the exit. I mean, exit is a constant search for the funders and the entrepreneur as long as you take VC money. Let's be clear. I mean, we're here only for a moment. So it means that when we entered, at some point we need to see if one day we could be in a position to exit the company, having done our job, that is developing and helping the company develop with the money we brought, as well as the experience. So as long as you take VC money, it's not like the bank. You need to think that one day there have to be a liquidity event where the people who have backed you at the beginning or at the growth stage can exit with a better valuation. It's very simple. As long as you understand that, you understand what it means to take the money from investors. I personally hate when young funders, and often the case of young funders, tell you, I mean, your game is to lose money. No. We know that the investing is a power of flow. So out of 6 investments, out of 10, maybe you will lose some money. So it means that you need to have big returns for the others. So whenever an investor invests in your company, he needs to see that one day he could make the D6 to cover for the losses of the portfolio. But however, having said that, when we give our trust to funders, it's because we believe in it. So it's also because at some point we think that the funders will find for us a nice liquidity event to have an exit, and maybe the funders will do an LBO, will go on, will find new investors. But this is part of the game. So this is why whenever we invest, we have to see, and especially on the deep tech companies, which company, which strategic group, because at the end of the day, it's about that. When it's a business that can develop itself as a business, you have many other acquirers, like the private equity funds, and it's based on, at some point on profitability. But for deep tech, it's based on who one day could buy this company, either another tech company, either a large corporate. So as for us at the moment, for the AI company, we're looking proactively to some nice company that could exit it. For entrepreneurs, it could be game changers. For us, it's a way also to show to our investors that we have very good returns. And sometimes it happened too early. I mean, for example, Glose, Nicolas Prinsen exited it with Medium in only 2 years. 2 years is short, but at the end of the day, Medium was the dream acquirer for Glose at that time, only in 2 years. So you have to be proactive. Regarding the investment, as for One Ragtime, we've been pretty busy last year as we did, I would say, 5 or 6 investments plus re-up. So we keep the same investment path. We were maybe more picky, looking really at company that could do a D6 when we invest in it, and while doing also impact companies. So on that perspective, I mean, again, I mean, we do not invest yet in hardware, but we've done some health tech, climate, software company, which I hope would be a very good success. But we try to conceal both impact and performance, and I have to say that on the impact company, it's even harder to find the one that could become a real business. But the good news is that the deal flow is still there. There's a lot of money and dry powder, in theory, on the paper from VC funds, so I guess this is the best moment to start a company.
Alexis or Julien David, do you want to complete?
No, I mean, like, I totally agree with Stephanie. Like, so we raised a lot, all the VCs. So now people are looking for opportunities, and now I'm trying to convince founder to go back on the road, basically. And so, as Stephanie was saying, we're saying like a lot of technology is available, a lot of VC are willing to finance people, and so you know, it's starting like a new era where it's going to be easy and nice again.
Merci à vous trois pour cette session. On peut les applaudir. Merci.